This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Lynn's picture saying looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a gigantic drawdown of 4.9 million barrels of crude oil, Cushing, Oklahoma drawing down another 875,000 barrels. But the thing is, those gigantic crude oil draws were offset by equally gigantic builds on finished products, with gasoline building 3.3 million barrels and distillates building 3.5 million barrels. So on net, that's a build, not a draw, of 1.9 million barrels of petroleum overall. U.S. production held steady at 13.3 million barrels, its plateau level. The crude oil drawdowns are really starting to get big now. But for now, the builds on finished products are making up for them. The question is whether the draws on crude are the beginning of a seasonal trend set to continue, and whether the products will soon follow suit. Unless we get a break above $85 WTI, the chart still looks exhausted, but those drawdowns breathe some new life into the market, so let's see if it lasts.
You know, Eric, I'm a little bit more optimistic about crude oil. I think that the price action has consolidated well above its 50-day moving averages, and the entire pullback was contained to $80, just the way that we were looking for the price action to balance itself if it was setting up for a potential breakout. Now, we haven't got the breakout yet in oil, but as far as I'm concerned, technically the chart is behaving. Now, even if we did get a technical breakout, we would come quickly into those April highs near $86, $87. That could be the first resistance point. But at this stage, I'm giving the bulls the benefit of the doubt that they're going to get this moving higher. Now, let's move on to equities. I want to get Nick involved in conversation. Nick, we have the chart on the S&P on page 3. What are the levels you're watching?
Yeah, Patrick. So right now, spot price on SPX is approximately $55.90, and we have an implied move for the August 16th monthly OPEX of plus minus 150 points. Therefore, the upper implied move is 57.40 and the lower implied move is 54.40. Right now, we have key resistance at all-time highs at 56.70 and key support at 5400. As I said last week, I'm inclined to think that we see some seasonality toward the downside into the August OPEX, somewhere around that 5300 area, perhaps. And I think we kind of chop around into the election as well.
Well, you know, it's funny you say the 5300 area because that is where the retracement zones lie of this April to July market rally. And more importantly, that also corresponds with those March highs. And so that would be certainly a logical place that if there was a correction where a potential support line could come in, if this is one of those typical 5% style market corrections. But what is interesting is that this market in general has been running since November. And so we've got a market rally that is going on 8+ months. And typically at some point when you have an advance of this magnitude, typically the market starts to exhaust itself. I mean, we're up almost 40% in 260 days. And so we're starting to see some of those signs and certainly saw some reversal candles. But what was particularly interesting about last week's CPI number was the distinct trigger it caused to create a rotation. And just to kind of put it into context, I have the market breadth on page 4, which we were talking about how very poor the breadth was, hanging around 50% just last week. We jumped to 76% in just 1 week as the breadth completely widened. But what was amazing was the divergence, which is that the equal weight S&P 500 in a week was up 5%. The Russell, which you nailed, we'll talk about that in a second, was up over 10%, while the Nasdaq was down 5%. So we have this scenario where suddenly there was clear sector rotation that kicked in. Now, usually this kind of extreme divergence where one is up and the other is down is not typical. Usually it's relative outperformance where the Nasdaq does better than the one or the Russell does better than the other. The fact that we saw the one distinctly ripping higher while the other very clearly distributing is very unique, and asks the question as to whether something like this is sustainable. And while I think sector rotation could be continued, I think that the indices will start to correlate, even if the small caps continue to outperform on a relative basis. And the bigger question, therefore, will be whether or not we see the markets here go through a broader pause and reversion, or whether the broadening of the market can keep the stock market sticky. The biggest obstacle, of course, is that on those market cap weighted indices, those mega caps are just so huge and such a big component that it's hard to imagine the rest of the components being able to keep progressing these indices higher if those are correcting. And so I still think the Mag 7 play a pretty big role in there. But last week, Nick, you nailed that Russell trade, calling the Russell long against the Nasdaq short. What's your thoughts here?
Yeah, so on the Russell right now, I'm inclined to think that we see a move higher toward their all-time highs at around 244. So last week we broke out and we're up about 12% or so in just about 5 trading days, which is pretty interesting because we're seeing a lot of money moving from the mega caps into the small caps. And I've been thinking this would happen for the past few months. I've been wrong for a bit, but now I'm right, I guess, right? So right now, I think we see that 244 area get tested out pretty fast on the Russell, meaning that there's about 10% more upside in the short term. That would take us to all-time highs. And beyond that, I think it's possible we push toward 260 in the next few months as well, as we see more rotation out of the mega caps into the small caps.
All right, well, let's move on to the Nasdaq, which has been down 5% in the last week on page 7. What are the levels you're watching on the Qs?
Yeah, so on Qs right now, spot price is approximately 483, and we have an implied move for the August 16th monthly OPEX of plus minus 20 points. Therefore, the upper implied move is 503, and the lower implied move is 463. Right now, we have key resistance at all-time highs at 504, and key support at 460. As I mentioned last week, I thought that we would see some selling in the mega caps, and we've already seen that start. I think we're going to see some more drawdowns in mega caps as we see rotation into small caps. So right now, I am remaining short via butterfly put spreads on the Qs, and I think I'm going to keep that thesis on until the middle of August or so.
All right, well, let's move on to page 8 where we have the volatility index. And when you reflect back on the last 8-9 months, this 15 level has been the upper boundary of the trade range. So we certainly had a spike in volatility with this, a few days of weakness in the market cap weighted indices, and that caused volatility to come up to this upper boundary. And this is, to me, a pretty important level because either this becomes a bigger correction and we see an April style spike up to the 2021 level on the VIX, or this is going to be the upper boundary of a quick 5% market correction and the buy and dip traders will step in here. What are the levels you're watching here on the VIX?
So with the VIX at about a 14 handle, we can expect to see top to bottom moves on SPX intraday of about 0.8%. We saw yesterday the largest downside move we've seen in many months. And I think this kind of forebodes for more volatility ahead in the coming month or two into the September OPEX. Right now, insurance is still cheap. However, it is getting more expensive as we lead into that election event. And I think it is very prudent if your portfolio is correlated heavily toward the S&P to be hedging using either puts or put spreads or collars perhaps.
So I want to move on to the U.S. dollar index on page 9. And we were, before last week's CPI numbers, hovering around 105, which was a pretty critical level in my mind. And we really saw a distinct breakdown in the dollar in the post-inflation numbers that is now doing some significant technical damage. not only have we seen a material rally in the yen as the US dollar yen has a mean reverted almost the entire June move, blowing through Fibonacci zones like a hot knife through butter, but also we have the euro starting to break to a higher high. And we obviously don't see the results of the ECB just yet when we're recording this, but it'll be really interesting to see whether a bigger dollar correction is underway. Because in my mind, when the dollar is going through a weakening cycle, it tends to be a tailwind for commodities and energy and so many other spaces that generally have been lagging and underperforming. And so if we go through a dollar weakness cycle, precious metals and all sorts of other assets could end up getting some tailwind, and seeing whether this trend persists is certainly on my mind.
Now, moving on to page 10, we have that gold futures chart. What are you guys thinking here?
Well, we got a new all-time high much sooner than was anticipated from seasonal trends. Normally, you'd expect seasonal weakness through the end of August or so, and then after Labor Day, things would pick up in the gold market. Seems we couldn't wait. So it'll be very interesting to see if we can hold above 24.50 now and sustain this new level, or if the market is going to retrace. But I think the bull market is clearly back on. The cup and handle pattern still targets 27.25. That's 2725. But there's no clear time frame for when that should happen, because after all, that cup and handle was a 12-year long pattern. So needless to say, timing exactly how long it's going to take to play out for the completion is anyone's guess. Since the Z4 contract, the December 2024 contract, is already above $2,500 thanks to the contango in the market, it already seems realistic to me that by the time of that contract's expiry in late November, we could possibly be at that 27.25 target level. Patrick, I'm very curious to know whether you have an upside target for gold in the intermediate to long term. In other words, as a completion for that cup and handle formation that's been in play for over a decade now.
Eric, the most obvious upside target is towards 2,700, but that's more of a short to intermediate target, something that could be even seen here in the third quarter of the year. The bigger targets, when you're really talking about a breakout to all-time new highs like this, could see this easily head towards even 3,000, but that would be something that would be a rally that could be seen into 2025, and I wouldn't use that as a trading target for any short to intermediate trades. One way or another, gold, it has beautifully broken out to an all-time new high, but what is interesting is that the breakout itself didn't see the other precious metals totally follow suit. Particularly silver keeps lagging a little bit. It would be really interesting to see a nice confirmation to see that the other precious metals all join the party. Then when you see gold equities participating, it really means that some flows are coming in here, and that would be a really good confirmation tool that this breakout will stick.
Now on page 11, we have that uranium chart. Eric, what are your thoughts here?
Well, the long-term fundamentals for uranium couldn't possibly be more bullish, and that story keeps getting more and more bullish every day. But the technicals have just turned from bad to worse. I think the reason why that's happening is probably that there's an informal buyer's strike among the physical market participants, and generally it's quiet summer trading with not much physical market activity and no metal traded on the physical market in most daily trading sessions. The buyers are not the slightest bit concerned by fear of missing out and are just sitting back waiting for prices to return to the sub $50 level, which apparently many of them are confident is going to happen. Now, I'm convinced it's not going to happen, but it appears that they're going to try to wait it out anyway. Many of my favorite uranium mining share charts flashed right shoulders and head and shoulder patterns on Tuesday. Then they completed those head and shoulder patterns with downside breaks below their necklines on Wednesday. In many cases, that left those issues to close on Wednesday well below their 200-day moving averages. So you've got head and shoulders completions to the downside and closes below those key 200-day moving averages. Now, these are technical signals that are likely to beget even more selling in coming days. So I doubt that the bottom is in just yet. Buying this dip is going to be the buying opportunity of a lifetime. But as always when buying dips, trying to catch a falling knife is tricky business. So you have to have some discipline, particularly in terms of saving some dry powder to buy even more shares at even lower prices if we get them in the future. So my call here is of the strongest possible conviction, and that call is that you want to buy the bottom of this dip that just started to break lower on Tuesday and Wednesday, and you want to buy it in size. Now, of course, the question, obviously, is, okay, if that's what you want to do, well, how much lower than the current level is that bottom going to be, and how long is it going to be before that final bottom comes? Well, that's always the hard part, isn't it? If I'm right about why this is happening, how long could still be weeks to months? If the physical market buyers are holding out for lower prices, the more we start to see lower prices, the more their conviction will increase and the less likely they'll be to abandon their price sensitivity. Now, I was already an aggressive buyer of uranium mining shares on Wednesday, and I'll be buying more shares at all the obvious technical levels below the current market. I have no idea how far this technical correction will run, but eventually fundamentals will take over and the bull market will resume. Remember, the name of the game is buy low and sell high. Low is what we have right now. We're likely to get even lower before this bull market resumes. But this is clearly buying season, and we continue to grind lower, looking for the bottom of this technical correction in a raging bull market in uranium and all things nuclear.
Yeah, we're going on a 6-month correction in uranium, and the Sprott Physical has been bouncing around as a closed-end fund at different discounts to net asset value, and has been muddling along these lows. But what's more interesting to me is the fact that we had some distinct selling in the uranium equities in the last few days. And it really seems like some people are getting exhausted from holding on to this big picture trend. And they're certainly rebalancing their sizings and exposures. Overall, I get the bull thesis, and it's going to be one that I still firmly believe will play out in the longer term. But on the short term, this distribution is very pronounced and not over. And so we're going to have to see where the short-term lows establish themselves before a new buy signal really gets underway. Finally, I wanted to just touch on page 12 on the U.S. 10-year Treasury yield. As yields now have broken the June lows, we continuously now are seeing the pattern of lower highs and lower lows as bonds are generally strong here. And this is, in my mind, the path of least resistance for at least the remainder of this year. My big call was essentially that bonds have bottomed back in October and that we weren't going to see lower lows on the Treasury bond markets in this calendar year. That doesn't make me super bullish. I just simply think that the sell-off was far too intense and certainly now has established a new range. I think we could see still yields drop under 4% here going into the third and fourth quarters of the year, and there could be money made in this as the Fed starts cutting. We'll see how this settles in, but overall, I think bonds are a good trade here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.